Hi, it's Helen Tarrant.
Hi, welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm actually going to talk about how to avoid buying inflated commercial properties. Now, we've seen people make this mistake many times in the market, and I think they're about to make that mistake again in the upcoming market, especially in 2021, because commercial property, for the first time, interest rates are so low. They're somewhere between anywhere from 2.5% to 4%. So you are being able to clear really good margin even if you stay in the Sydney, Melbourne market and you're buying properties at 4.5% or 5% yield. So how do you stop buying inflated properties where the market is so hot? So one of the things to really be careful of is, number one, your returns. So if you don't hit that return, walk away from the deal. Number two, look at your rate per square meter in terms of rentals and also in terms of sales. So how much is your tenant renting per square meter? Because if there's limited demand in the market in terms of limited stock, that particular type of property, you might be finding that the tenant is actually paying higher than market rent for it. And also there's a lot of new stock coming on the market. And of course, because they're new stock, the tenant's paying a higher market rate, but also they're selling it at a higher market rate as well per square meter. So be really careful of that as well. So there's some ways to really buffer yourself from buying in a hot market is, firstly, go against the trend. So at the moment, warehouse properties are really hot at the moment, and there's heaps of people that in the next year or so will absolutely get burnt because they've paid too much for that property. So just be really careful with that. Look at whether there's green fields, look at whether there's areas where there's a lot of developments coming up, and that be careful of short leases, because when your tenant come to renegotiate, there might still be downward pressure on that rent as well. So just be in mind that in the next couple of years there is going to be downward pressure on that rent. So be careful of that. The other thing to look out for is really inflated rate per square meter. So if you are looking at a property that has a tenant that's been there for, say, 4 or 5 or even 10 years, and each year they've had a rental increase, their rent is going to be above market. So you'll be paying above market rent. So always look at what someone else is paying, not just now, but in your local complex, but someone maybe 2 streets down, 5 k's around the area, so that you really get an accurate gauge on what the rent is per square meter for that particular type of property, and also for particular type of tenants. But medical tenants always pay higher. You've got your normal trade tenants, which will pay lower, and of course your professional tenants will pay mid to high tier, depending on the type of tenant as well. So really do your due diligence, and due diligence really pays off as well. And that's why you should hire a professional and have a team around you to really help you through that process as well. The other thing about buffering yourself so that you're not buying inflated is to really go in, even if you're buying cash, is with valuation. So the valuation is the most important, and really look for a conservative valuer. At the moment, the market is pretty conservative because of COVID, but also make sure you check what the valuation says in terms of what the local rents are and where this rent sits in the market. It's better to be below market, charging your tenant below market rent, than above market rent. So valuations is a key point now as well. And then the other thing is, be aware of costs that could blow out on a property. And that means that when you're buying a property, you could be buying a property and then having to fork out extra money for the capital works on the property. So be careful of things such as a property that may have a leak, a property that may need some refurbishments, a property that may come across as, yes, the tenant's been there for a long time, but the tenant also has a lot of, they've been there, but they haven't really taken care of the property, but you may potentially have, capital works such as air conditioning, maybe there might be some waterproofing issues, there might be some kitchen or bathroom issue, there might be some leaks. Make sure you really budget that so that you don't buy the property and then end up with having to fork out another $10,000 or $20,000 on top of that as well. So that's something else to be aware of as well. So I know that there seems to be a lot of things to be aware of, and I'm not trying to scare you, because it's all about you getting into the right commercial property deal. But the main thing is, we're coming into a very hot market now, and there's a lot of people, a lot of buyers buying anything that has a return, because it's better than putting money in the bank. But as an educated commercial buyer, you still have to pick and choose. So make sure you get the right tenant. Make sure you really do your due diligence around the rate per square meter. Walk away from the deal if you are not going to get the returns, because ultimately, if you are getting below market returns, so if say 7% and you're buying in at 6.75%, then it might take you actually 2, 3, or 4 years before you actually make that money back. So you're not going to get any capital gains from that property. So that's one of the things. That's why you need to stick to your returns. And look, I know it may be hard in the market, especially in the next 12 months, but that's also one of the things we specialize is finding you those high yield properties. But if you're going out there and finding it yourself, stick to that yield. If not, don't get emotionally involved, move away from that deal. And then finally, just beware of compliance, because there's lots of warehouses out there, and there is also lots of properties out there that have structures that's been built into the property by the current tenant or the previous owners that is non-compliant. So make sure you really check that out, because you don't want to buy a property and then have it being your problem in case the tenant does something to the property, or the council comes around and shuts you down or tells you to pull that structure off, because ultimately it means less lettable area for you, more cost for you in the future. So if you're looking at anything that has a structure in it, make sure it is compliant as well. So hopefully that's helped you to understand a little bit more about how to avoid paying for overinflated properties. Really do your due diligence, look at the lease, compare it with other leases and what they're getting in the market. Have a look at the previous auction results and other sales around the area. Really educate yourself before you go into a deal. And of course, if you need a bit of hand holding, a bit more of an advice, go to helentarrant.com, check out my education, reach out to me, and I'll jump on a strategy call and help you navigate through the maze that is commercial property cash flow. So until next time, good luck on your search, and I hope you find some fantastic deals out there.